Good morning, all. It's now 10 o'clock, and glad to be with you this morning. Good to see you there, Pat, Hazel, Mark, Dinah, of course, Lasago. We're going to talk just a little about the bigger picture on currencies this morning, because I think we're in, as ever, some really interesting times. And these interesting times are being brought about by largely the currency wars that we've seen. And in terms of markets, where there's an awful lot of talk about particularly stock markets, which are just sort of endlessly massaged higher. And if we just consider that for a moment, we've seen a market which is just a one-way bet. It's just been moving higher and higher and higher, largely put at the foot of the door of the Federal Reserve with QE, which has just been bouncing this market ever upward, in the hope, in the politicians' hope, that a strong stock market will provide sufficient feel-good factor that it'll rub through into the rest of the economy. But of course, we've now been in QE for a long, long time, and we can just look at the numbers. We can just see how long we've been at it now, since '09. Been at it for about 6 years. And whilst there are sectors which are booming, there are a good many sectors, particularly of the population, which are managing exactly the opposite. And of course, there are booms and there are busts in various economies throughout the world. So this manipulated market that we've got is one that has been manipulated through bonds, through massaging interest rates, keeping them low. And we can see one consequence of it, but we're also seeing a lot happening within the currency markets itself. We're seeing lots and lots of major moves, not least of which has been the move down in the euro. Now, what the ECB have been trying to do, they've been trying to reduce the value of the euro so that Europe's exports outside of Europe are going to be much more competitive, and it will then boost the European economy. So that's what the currency wars are all about. It's competitive devaluation, which has been flavour of the month for a good many years. Now, of course, the euro hasn't responded quite as well as some markets. We've had something of a tumble. At the moment, it's just pausing. And of course, we've had special situations in Europe, not least of all has been Cyprus, then following on to Greece. Greece now, which has been well and truly contained and is now a non-problem. And so what we'll probably find is that there may well be still some further strength to be seen in the euro because of those problems being solved. But let's just consider, first of all, one or two of my sort of favourite currencies. And amongst those, of course, is going to be cable. We can look at cable just in a little bit of detail. But first of all, looking at this longer-term monthly chart, what's going on with the UK? Well, in the UK, if we just consider the debt situation, we've actually got, depending upon the figures that you actually want to look at in terms of external debt, an external debt which is substantial, and it's being compared to Japan's. There are, of course, official figures, there are unofficial figures which are banded around, but the external debt is really quite enormous. So what stops the pound collapsing is the growth in the economy. Now, the economy, without a doubt, has been growing. The number of people in employment has been improving. And consequently, one will balance the other. Provided you've got a strong economy, you've got money coming in, it doesn't really matter what your debt level is, it can be serviced. As soon as, though, that debt starts to go up still further and an economy starts to stagnate, moving out of growth, then of course, the problem is multiplied many, many, many fold. So in terms of cable, just this morning, we had construction PMI figures out. Standards of 9:30 announcement. And if we just consider this 15-minute chart for a moment, we can see the effect was that the currency just collapsed. It just shot on down. They were unexpected numbers. And so it's kept within the trading range, which was built up yesterday afternoon, kept well and truly within it. Note that it's just popped up to that all-important bat level, put in a double top, and then it collapsed on down. One imagines now price today is going to find it really quite difficult to recover any further. I want to then just look at the daily chart with you, because the daily chart is actually telling a really interesting story. And it's this recent price action that I'm most interested in. What this most recent price action is telling us is that we've got a whole series of very, very spiky long tail candles. We've got 1, 2, 3, 4, 5 of them. And if we just look left, we can see that this line, this area that keeps pushing price down, is where we've had a degree of support previously, and we've had a fair old bit of price action just over here. So we're in this range, and sooner or later we're going to break out of this range. Let's put another line across to show us approximately where this range is. And so the question is now, will the currency wars come to the UK in a big way? Meaning, will we see some form of competitive devaluation of the British pound? Now, is this likely or is this not? Well, on the face of it, it's not, because we've had the economy talked up quite considerably by our Chancellor of the Exchequer and our central bank man. So the economy is looking pretty good at the moment, looking as if it's going to really start to grow. But one thing I would question just at the moment is that on Thursday we're going to have the usual interest rate announcement, and there will be probably quite a lot of talk around it, and we'll find out who has been voting for and who has been voting against any possible rate increase. And I'm just going to posit this right now, in that, as we have seen, I'll bring it across, we've seen the construction PMI figure, look at that, coming at 57.1, as opposed to an expectation of 58.6. Now, that is not absolutely massive, but look what the previous one was. The previous one was 58.1. The expectation was that it would be improving somewhat, particularly with all the talk that additional houses are going to be built to satisfy the demand for houses in the UK, etc. So this one has just been a little bit of a bolt from the blue. So back to the chart. If on Thursday, and it's a big if, we would find that the consensus is for no interest rate rise, number one, and number two, some further suggested forward guidance that just maybe interest rates will not rise, the chances are we're going to get a move downward. And that move downward could possibly take us out in that direction of this trading range. Now let's just argue the opposite scenario to that. And the opposite scenario is that Carney is actually right. And Peppino, I absolutely agree with you. Yeah, the data is not all that brilliant. It is not all that brilliant. But let's just argue the opposite case for a moment, that Carney has been talking up. He's been talking up the economy. He's been talking up the prospect of needing to raise interest rates. And if that were to come to pass, that the majority do actually want a rate rise, then that's going to be the direction of the breakout. And I feel that we are going to see a breakout one way or the other. And I have to say, I'm absolutely sitting on the fence, except that, I'm a tad more bearish than bullish. Tad more bearish and bullish on this one. So this is a really interesting pattern that I'm looking at. We can look at this in several different ways, but what I'm looking at is the fact that every time price then has pushed up towards this 157 level, it's been slammed down. And it's been slammed down consistently over the last few weeks. And there may well be a reason for that. And the reason may well be that if the actual data is not as good as both our politicians and central bankers would have us believe, then we just may well find that the market will devalue the pound. And I wouldn't be at all surprised that both central bankers and the government would be only too pleased to see the pound tumble somewhat. Now, let's just go and look at another currency for a moment. Let's just go and look at another currency. And this one, let me just show you this chart. Bear with me, half a mo. Now, hopefully you can see that all right. Let me just explain what it is. It's the Commitment of Traders report. And it's the Commitment of Traders report for the Australian dollar. Yeah, hi, Pan. Good to see you. Good to see you. Right, yeah. Absolutely, yeah, that's right. I mean, do you see cable going up when Carney raises? Well, yes, possibly. I'm really hedging my bets on it. We'll actually get back to it because it's part of the dollar picture, and you've mentioned Yellen, and I've noticed there you said when Yellen raises, and there's actually a question mark on that when, which we'll get on to in just a second. So, yeah, I mean, absolutely. And I'm sure that they coordinate these things, and they will coordinate these things very, very closely. Back to this Australian dollar for a moment, because we've had a really interesting situation today. Now, quite simply, what this is showing us, this is a report of leveraged funds. Okay, so these are the speculators in the market. And there are one or two lines to ignore and a couple of lines to look at closely. And the first line to look at closely is this blue line, okay? This blue line. There it is. It starts off and it's hugging the 20 level for a fair bit. It spikes up and then it comes on down. You can see how it's been coming down and down and down. Now, they're the number of longs that there are in the market for the Australian dollar. There aren't many, or at least they've been reducing. But if we then contrast this to the shorts, which is the thin yellow line, okay, see that thin yellow line? Notice how this has been going up and up and up like crazy, and particularly in the last sort of month. So we've got this big disparity between the number of shorts in the market and the number of longs. So net-wise, we've got this net position, which is obviously the green line. And what that is telling us is that there is a massive imbalance here, and the massive imbalance is on the short side. It's on the short side of this market. Now, if we just pop over to the Australian dollar for a moment, There we are. I've got some charts moving up. What we can see is that, yeah, price has been coming down. And for a lot of this, those speculators have been absolutely right. And in fact, I've been shorting it myself. I've been shorting it like crazy. And then what we've actually had today is this spike up. And we had a little bit of news overnight that the widely expected interest rate reduction in Australia did not happen. It did not happen. There was an expectation that because of China and the slowdown in China and perceived problems with the domestic economy, then the only way out is to push interest rates even lower and get this currency down to below 70. And indeed, a good many are saying, right, well, it really needs to be down below 60. Below 60. So what actually happened then was that the market was well and truly caught in a bear squeeze. And a bear squeeze is when everybody's short, every man and his dog are short, and his wife, and his taxi driver, they're all short, and then something comes out of the woodwork to push price up, and all of those shorts get squeezed like crazy, and that's exactly what is happening this morning. They are being squeezed. Now, price action over this last week, if we just look back on some of these candles, is really quite interesting. Hallmey Day yesterday, indecisive, doesn't know where we're going. Friday, up, down, ends in the middle. What do we got? We got a spinning top, doesn't know where we're going. There are buyers and there are sellers in there, but nobody is going to commit themselves strongly on either side of this market. Thursday, what do we got? Doji Day. Almost equal, well, not quite, almost equal tails on either side of the open and close. And we can just look back and see that we've got this engulfing on the upside, which actually gave us the heads up that maybe just something interesting is going to be going on here with this market. And that was the cue. That was the cue to see that engulfing when the news and certainly the commentators were all saying, it's a sell, it's a sell, it's a sell, it's a sell. So we got the heads up that just maybe, we were going to get quite a good rally. So one of the interesting things is that what they've got in the in Australia, they've also got a bit of a housing problem. In fact, they've got ridiculously high housing prices, and that's going to be one of the reasons why rates did not get reduced. So there we are. Interesting little anomalies in the market, but every now and again you get exactly the opposite to what the consensus is happens. It catches the market out, and everyone is caught on the wrong side of that market. And just this morning, that has happened marvelously. So yeah, good point there about the graphs. Yeah, this is the standard stuff. Quite interestingly, the CME this is the second generation of their COT report interactive guide. They still publish, of course, the raw data, and the raw data you can look at and you can sort of play around with. But this is an entirely free, and it's brilliant. It's a brilliant little feature. And so, you don't necessarily need to try and produce your own graphs or put them on a spreadsheet to interpret the data. It's all here. But you just play around with the settings. And in fact, you can see across the top here, these are just the futures. We can sort of mix it up with the options data as well. And all this is just clicking the leveraged tab just here. And then that's what you get. So you can pick this up from the CME website. And let's see if we can just copy that into here. Let's just pop this in the box. Click on all, paste, send. Right, there we go. That's the link. That's the link. So it's a brilliant it's a brilliant little guide. You just got to be a little bit careful on how you actually use it, because you can end up with far too many lines, and the whole thing can be just a jumble. So you just need to just be a little bit cautious with it. And of course, the actual numbers are just down here at the bottom, and you can go forward. Well, can't go forwards. You can go backwards and check back through the history of this thing. You can display more history if you wish, or not, as the case may be. So it's a superb product. I'm actually time's been a little bit tight for me just recently, but I will be producing a video guide on actually how to use this thing, and I shall churn that out in the next few weeks, I guess. Right, so there we are. COT reports. It's one of the best indicators of the fundamental position that you will ever get. And I'm very much a contrarian, so that when I see that there is a big imbalance, when I see that there are a fantastic number of shorts in relation to the number of longs, then I start to sort of build up an impression that they're all wrong and that it's going to go the opposite way. Now, that has served me reasonably well over the years, and a contrarian view is something that I've always had. I think I always will have. Right. Okay. So where are we going to go from here? Oh yeah. Let's just take a look at the Canadian dollar. And before we look at the Canadian dollar, let's just consider some of these key commodities. And of course, the key commodity that we're all interested in is oil. I say we're all interested in. I most certainly am. And I'm so pleased now that my diesel car, the cost of diesel here in the UK, has now come back to where it should be. And it should be lower than the cost of petrol. Because if you just think about it, when you've got a barrel of crude oil and they bung it into that thing called a refinery, and they churn all this stuff out, well, petrol is more refined than diesel. And so consequently, you're going to get less petrol out of a barrel of oil than you are diesel. And so it's back to, 14 years, I think it was something like that, when there was a difference. When it was back in kilter. But of course, the popularity of diesel cars and so on reversed all of that. So we're now back to parity. And the cost of me filling up my car now is considerably less than it was just a few months ago. Anyway, what's going on with the oil price? Well, it is going down. This is in a downtrend. I think we can all sort of work that one out. And, it's a straightforward downtrend. And the decline has not stopped yet. We can see that it's not stopped yet. Goodness knows where the floor is going to be. We just do not know. And so whilst this is going on down, we've just got to respect that fact. And then let's look at some things such as one of the economies which is very, very dependent upon oil. And of course, that's the Canadian. And the Canadian has been going absolutely gangbusters on the short side, or the US dollar, I should say, has been going gangbusters against this ever weakening Canadian dollar. Why is it causing such a problem for Canada? Well, quite simply, because they have got a lot of oil. They are a commodity currency, and if the oil price drops, then they're going to catch a cold. Add to that the fact that their shale oil sands, etc., their cost of actually producing a barrel of oil is substantially above those who've just got to pump the stuff out of the ground with a simple nodding donkey. Then you can see they're all in a bit of a bind. Plus, we will find that, and this is certainly happening in the fracking area, that the amount of leveraged money that has gone into oil production. I mean, the people who have bought the bonds, who've lent the money to a tremendous number of these oil companies, will never get that money back. And so consequently, the Canadian economy is in a bit of a bind. It's in a bit of a bind. Yeah, nodding donkey, nodding donkey. So there's no surprise that the Canadian dollar shouldn't go. And we've had a brilliant run on it, an absolutely excellent run here, whilst all of this has been playing out. So there we are. Believe the stories or believe the stories not about why the oil price took so long to collapse when the world economy was quite clearly in trouble. And the world economy is not in growth. All we need to do is I haven't actually got a chart that I can show you, but the Baltic Dry Index, which is it's the best thing to look at in terms of what's going on in the world economy, because it's like the transports, the old Dow theory. If the Dow and the transports had to be going in the same direction. One had to confirm the other. Well, if the Baltic Dry Index is going down, it means that worldwide GDP is falling, and the Baltic Dry Index has been at a low level. It's been collapsing, and the number of ships that you see on the sea that are at anchor, that are just sitting there, or they're moving very, very slowly and gently to conserve fuel, etc., because there is not quite so much demand for their services. It's a reasonably obvious thing. Now, I've got two other ones that are reasonably important that I just want to look at here. And the first one then is the US dollar against the Japanese yen. We all know the story. We've had the Japanese yen going through a process of massive collapse. And of course, there are all sorts of reasons for this, not least of all the amount of QE that the Japanese have indulged in. And of course, the numbers are, well, they're sort of mind-numbingly large that we can't really quite get our heads around, apart from the fact that the yen is such a tiny denominated currency in relation to the US dollar that, of course, the trillions start to, you start just not to quite understand what's going on. But there has been this massive QE. Now, I just want to say a few words about Japan, because Japan are different. They are different to other economies. And the Japanese psyche is such that, in contrast to the average Brit, we tend to be a cynical bunch of people. Now, clearly, I know there are a good many Brits in this room just at the moment, and I know one or two that I can see in there, and I've met quite a few of you guys, and I know that a good many of you are really quite cynical. Didn't want to lump everyone into that, so I'm not going to mention any names. But we're a cynical bunch, and whenever our government sort of tells us something, we say, oh, yeah. Oh, yeah. But in Japan, it's different. And they are great consumers of government debt, their own government debt. So a lot of the debt of those trillions, a massive amount of it, is actually held internally, domestically. And that makes all the difference. Had it been held by us, the US, well, I know the US actually owned quite a lot of it, but if the majority of it was held externally, then that would become dodgy debt, much more so than the internally held variety. And so what we've actually found is that maybe for the Japanese longer term, it's not quite such an issue. It's not quite such a problem. So we've had this big run up, and the question is, and this is the question: has it gone far enough? Has it gone far enough? Are we going to see that now that the yen, the dollar yen rate, has got itself up to this 124 level, where it was way back there in '07, has it gone far enough right now? Well, the majority of people are saying, oh, no, it's got further to go, thank you very much, it's got further to go. And I think probably at this stage, let's just bring on the COT report back. So the consensus would appear to be, let's just see if we can do the same with this and see what it's going to show us. Right, there we go. Similar sort of thing. The blue line are the longs in the market. The yellow line are the shorts in the market. So the majority of people are still, the majority of traders are still short on this market. But just look at it. Just look at how the shorts peaked. And they peaked there early June, but they've been coming back a bit. And the number of longs, well, has been starting to pick up a wee bit. And that's starting to just tell a story, and the story is that maybe, just maybe, we've seen the highs for the moment. So that's the Japanese yen. And, you know, do they actually need an ever weakening yen? Because one of the problems that they've got is that they import an awful lot of stuff. Now, a weak currency is great for exporters because it makes their products cheaper overseas. But the other side of that coin is that, well, if you've got to import stuff, it's going to cost you more. And of course, they import a tremendous amount of stuff for domestic consumption. And if you've got domestic prices going up, then, you know, that can help the inflation along, which they're looking for. But it will also reduce the amount of money available for other things, and consequently, it can be a drag on their economy. So it's a real double-edged sword, that one. And there are noises coming out of Japan saying that, well, yeah, just maybe, it's all gone far enough. It's all gone far enough. Yeah, Z, you're quite right. You're quite right. Yeah, it's a week late. Is it reliable then? Well, it's a big picture thing. You're not going to use this. You're not going to use this as an indicator for your 15-minute chart. But what it will do, it can give you the heads up on the bigger picture where you just might be ready to get a trend change. And if you actually start to see the picture that the COT is telling you getting played out in the longer term charts, then that will help you with that 15-minute chart, because it'll tell you that, yeah, you know, maybe the predominant trend is going to be in this other direction. So, yeah, in that respect, it's a longer-term, big-picture look. And, you know, but by looking at the big picture, looking at daily charts, weekly charts, monthly charts, it'll actually make you a better day trader. It'll make you a better intraday trader. Because you're going to be trading that much more with the wind at your back, as opposed to trying to push against the wind. Right, over to the dollar. Now, there is a consensus at the moment that this dollar is going to go higher up. That's the consensus. And the consensus is the reason that it's going to go higher up is that interest rates in the US are going to be going up. That is the consensus. So there we go. This week we've, it is this week, isn't it? Of course it is. This is the first Friday in the month. We've got non-farm payrolls. And what we'll be looking for is to see if the non-farm payrolls figure suggests that the economy is growing or indeed is not growing. And that will, no doubt, sort of inform sort of what the markets, what is going to happen to the dollar, certainly over the summer period of August. Now, we have had such a consensus over a fair bit of time that just everybody believes it. Everybody believes it. But the reality in the market, in the real economy, is that. Let me just bring this across if I can. That the market has believed exactly what Janet Yellen has been telling us. But just consider this for a moment. We had the FOMC tell us that they hinted, and this is the key paragraph there, the FOMC hinted it does not need to see a lot more progress in the labour market before the employment leg of the test has set for interest rate liftoff has been satisfied. Previously, it said it would raise rates when it had seen further improvement. Now, it only needs to some further improvement. So, one word, some. One word has just switched this debate a little bit closer to the prospect of interest rate improvement. Now, we've got to be a little bit careful because there's going to be no, at this last meeting, there was a statement. There wasn't a press conference. So holiday times, that happens. Back in September, middle of September, we'll get then the full 9 yards of not only a statement, there'll be a press conference, etc. And so it's going to be September, widely watched as being the prospect of an actual interest rate rise, or indeed not. And we can argue this one both ways. And by arguing for an interest rate rise, well, it's been talked up. It's been talked up. Does the data actually back up the talk? Well, it hasn't really backed up all of the talk. And consequently, there's a fair chance that the dollar, if having had this big run up to 100, then this consolidation, which hasn't managed to really decisively move higher, there's a fair chance that if the Fed and Janet Yellen start to say that, perhaps we haven't actually seen this some further improvement in jobs, and consequently the interest rate increase is put on hold to not actually happen in September, but they say, we might do it in December. And I'm gradually now coming to the view that there will not be an interest rate increase. What I'm formulating the opinion is that all of this talk on interest rates moving up is designed to try and cool off the stock market. And we've seen the stock market cool to some extent. They've got a real difficult balancing act. Because to any observer, the stock market is a bubble. it is ridiculously high. It's been going up and up and up. On financial engineering, it's been going up on share buybacks. It's been going up on all sorts of things. Some sectors have been doing okay, but the majority have not. And consequently, yeah, has she actually got the nerve to try and keep this balancing act going, which is trying to get everybody to believe that interest rates are going to go up, but they're not actually going to put the rates up because the economy just cannot stand it. One wonders if there could be a minuscule move in interest rates that they just might push out there, which temporarily could well have some effect in the market, but then it could become disappointed, and that dollar index could possibly just tumble and collapse out of the sky. And that's the big question, Pan. Yeah. Which one's going to blink first? Which one is going to make the move first? Well, it's concerted action at the moment. I believe it's concerted action by them both to try and create the impression that interest rates will be going up. And my expectation is that it will probably not happen. There we are. I wait to be proven wrong. Now, I'll just show you this chart because it's a superb correlation. It has been over a long, long period of time that the US dollar against the Japanese yen and the US stock market, S&P futures that this is on the top, they work not quite hand in glove, but they work somewhat together. And what we can see is that the stock market then has just been meandering along here and going nowhere over the last few months. Well, most of this year, really. Yes, it has moved up, but not a big move. And then what about the US dollar against Japanese yen? Well, again, you know, we've had a little bit of a bump up, but it's stagnating on the sidelines. It's stagnating on the sidelines. If we were to get a decent move in this dollar, if my assumption is entirely wrong, that the market does grab hold of the idea that the interest rate rise is actually going to happen, we have got a beautiful little reverse head and shoulders, and I will be in the queue to further short this US dollar, the Japanese yen against the US dollar. But there's a pretty fair possibility that that won't actually happen and that it will start to just then meander sideways. Yeah, I mean, that's, 2% growth is what Western economies sort of need for stability, etc. Stability has come at a cost. And we know the big disparity between, we're told the top 1% and the bottom, or the top 10% and the bottom 10%. The disparity has got ever greater. That's the big cost that there has been with QE. And try to keep that 2% growth is the aim of all central bankers. As soon as it whizzes up above 2%, they're into inflation, and of course a fair number of their electorate are going to be disadvantaged while others are advantaged. If it drops back the other way, then you get another group of the electorate who will be the opposite groups of the electorate who will be advantaged and disadvantaged. So the 2% goal is the one that they all try desperately to cling on to and hold. Now, over to the commodities just for a moment, and I just want to mention one or two others. We've looked at the oil price, tumbling. The next one to look at, which is this one, which is variously called Dr. Copper. It's the HG market, and it's copper, the most widely used industrial commodity for all sorts of things. Pretty well all cables, to speak of, are made of copper. And consequently, if the price of copper is going down, it means the demand for copper and consequently the amount of cables that are being used is reducing. So copper is telling us that GDP is not all that cracked up to be. We've got silver, which is moving on down. Well, we've now got the soya complex starting to move back on down somewhat, although there's a whole series of other influences there. And then there's gold. Where is gold going? It just might be building a base here. We're starting to get, coming out of the woodwork, a lot of commentators telling us now that gold is actually going to move right the way down to 800. And that would be consistent with quite the opposite of 2% growth. What we appear to have is a degree of inflation which is somewhat higher than the inflation figures that we are being fed. And we appear to have growth which is considerably lower than, again, the figures that we are being fed. And gold has been reflecting that fact that we've got a degree of deleveraging still to go through. There could still be negative inflation, deflation, and consequently gold is reflecting that. But at some point, and this is where contrarianism is going to come in very, very strongly, we will find that everybody is saying, don't touch gold. It's just hopeless. It keeps going down. And if it were to get down to around about that 800 level, what a buy that would be. Quite simply, because if we do get more heavy deflation, the response will be more QE. And that QE is going to be put not just into bonds, it's going to be put into our pockets to spend. And as soon as that does actually happen, by all sorts of different mechanisms, that is when inflation will absolutely take off. And gold, you want to grab as much of the real stuff, of the actual, the bars, the Krugerrands, however you can get it, you want to keep as much of that stuff as possible, because the massive inflation, when it comes, will dwarf anything that we saw way back in the 70s. Absolutely. Keep blowing those bubbles. Okay, guys, well, I think it's probably time that I brought this to a close. Many thanks for being with me today. Thank you very much indeed for your excellent questions, and I look forward to being with you again next month. Bye for now. Yeah, all the best, Ray. Thank you. Thanks, Pat. Thanks to Sergio Pepino. All the best now.